Hello, fellow RoboCapitals. Hope you're well. So the new inflation data is out. It caught the market off guard. And here is what you need to know about the inflation data and how it pertains to the Fed dropping interest rates in their next meeting, or maybe how the probabilities of increase that they're going to continue to pause. We'll get into it in just a moment. And then we're also going to go over some other data that I think you've got to be aware of. And the mainstream media just isn't talking about it. And we're going to go over a few different things here. Then at the end, we're going to go ahead and connect the dots like we usually do and hopefully give you some actionable conclusions here. So, first and foremost, let's go over what's happening with FedWatch. This tells a big, big story here. We've gone over this a few times in more recent videos, and it's the probability the Fed drops by 25 basis points at the July meeting. So this is coming up in about 30 days. So let's go over to Fed. Oh, no, that's GDP now. My bad. We're going to get to GDP now in a moment. So we've got FedWatch, and for those of you who watch all of my live streams, you know that 3 or 4 days ago, we were right around 80%. So 80% probability the Fed isn't going to do anything. But then we had some soft economic data come out, to say the least. And I went over this yesterday with the inventories and with the GDP being the final revision, being adjusted down to a negative 0.5, and then deficits going up. A lot of things contributed to this. But then we saw this go all the way down to like 73, if I'm not mistaken. And then this morning, it bounced right back to almost 80%. Why did it do this? Why did it bounce back today? Well, that brings me to the inflation data I was talking about in the title. And the reason I said, I made up that tweet with the Fed saying this changes everything is because as of yesterday, I think there was a much higher probability. If you would have asked me my base case, I would have said probably 50-50 that they actually cut in July. And remember, it's not just me saying that. It's Waller coming out and talking about how he would like to see a 25 basis point cut in July. It's Bowman, I think the gal's name is. She's also reiterating what Waller is saying, that she would also like to see this 25 basis point cut in July. And it's really just kind of Jerome Powell that's digging his heels in and saying, I'm still a little bit more worried about inflation than I am the labor market. A lot of the other governors are turning dovish because they're more concerned about the labor market than they are inflation. The opposite of Powell. But today, I think this changes everything. It definitely changed the odds and the probabilities of a Fed rate cut. That's for sure. So let's shoot over to the calendar and see what on earth happened today. So, it just changed this on me. That's annoying. Okay, now we're at this week. I had it all queued up perfectly. So we've got consumer sentiment that increased substantially. So that's good. It's still very, very low. It's like 15 or 20% lower than it was a year ago. But month over month, it's definitely improved. But now let's look at what's happening. Actually, you know what? Before we get to the personal income and spending, I want to look at the core PCE. And this is why we saw the probabilities go from 73, wham, straight back up to 80% for a Fed pause. So in this, everyone says that this is the data point that they fixate on. I don't know whether that's true or not. But core PCE year over year, the expectation was for 2.6. Last month we had a 2.6, and it came in at 2.7. So the reason here, obviously, is month over month. They were expecting 0.1. We got a 0.2. I don't know if this is the start of hyperinflation. I probably wouldn't go that far. I mean, it's highly unlikely that there was nothing about the tariffs that wouldn't slightly increase the core PCE, let's say. But the question is it just a price adjustment? And then what happens next? And how does that impact overall spending? Because I was doing a webinar earlier today with RoboCapitals Pro, And we were talking about how like 40% of the CPI basket, and I realize PCE is different than CPI, but I'm kind of just using this as an overall proxy for inflation. But the basket's about 40% goods. So that's really 40% can be impacted by tariffs, but the other 60% is all just services, like domestic services. So that's not really impacted. So you have to ask, okay, even if this 40% goes up slightly as far as the prices, then what happens to the prices of the other 60% of the stuff? And the example I always use is Walmart versus airline tickets. So domestic airlines, right? Or domestic air travel. So if you have to pay a little bit more over here because of tariffs, assuming that the producers aren't eating the costs, I think there's probably a little bit of both going on. But then you're going to take spending away from something else. So it's likely the prices come down over here, which is exactly what we've seen happen in airline tickets. Now, I want to move on to the income and spending because this, I think, is another data point you need to connect the dots and to do a thorough analysis as to how this changes the probabilities of the Fed dropping more or less than the market expects for the rest of the year. So it is true. We saw the core PCE tick up by 0.2% month over month. Is this something we should pay attention to? Absolutely. But we also have to look at the other data, and we see personal income and personal spending down, negative number. And it was a huge miss. And by the way, they were explaining the income away by saying, oh, it's no big deal because it's just, I don't even know what they said, that, winter or cold weather. They always use that as an excuse. But my argument is always, okay, well, that should have been included in the expectations. And like, did the analysts not know about the cold weather? Like, if you're using that as an excuse, and I'm not saying they are, that's the excuse they always use. So I'm just assuming that. But if that's whatever the excuse is for why this was a huge miss, you would think that that would have been included in the expectations to begin with. So I think regardless of how you want to rationalize this or whatever excuse you want to make, the bottom line is we had a 0.7% miss on the downside. Expectations were for 0.3, and we had a negative 0.4. That's on personal income. And then with spending, it's a miss as well. And we were negative, not as bad though. We were expecting 0.1%. We got a negative 0.1. So you have to look at this from the Fed standpoint, look at their mandate and say, okay, we've got unemployment, we've got labor market, we've got the jobs, if you will. And then over here, we have inflation. So Jerome Powell is leaning way over here, like the biggest risk is that we have a reacceleration of inflation, not just a price adjustment due to tariffs, but a reacceleration of inflation. And then over here, you have like Bowman and Waller that are like, we think the bigger risk is the softening in the labor market. So just by looking at these data, I don't know how you don't come to the conclusion that sure, it was 0.2, but personal income down by 0.4% and personal spending down by 0.1%. How on earth can you argue that this is going to lead to sustained acceleration of consumer prices? There's just that dog don't hunt. Like, it doesn't make sense. Like, there's no, like, the only way that you can have a sustained acceleration is if you have demand increasing, or if you just have supply just completely going down. And I don't know the argument for that unless Trump came out and said, 100% tariffs on everything. So the imports coming into the United States just completely stop. And then we have this massive supply shock. But even there, you would have some big time inflation. I think even the broader basket would increase because the 40% would go up by so much that it would even, I think, temporarily outweigh the decrease in the 60%. But then that's going to lead to so much demand destruction. I think that's going to roll over. And that would, ironically, I think, lead to a disinflationary outcome, all else being equal. And when I'm talking about, assuming the government didn't do anything, I don't know what the Fed could do, but really about fiscal there. So now I want to give you some more kind of data points to include into your analysis. So for me, looking at this, if I had to predict now what the Fed is going to do, it would not be 50-50 like it was yesterday. It would be, it'd probably be close to 80-20, maybe 70-30, 70-30 that they're going to pause. But that's just me trying to predict what Jerome Powell is going to do. If I'm going to say, all right, should the Fed be more worried about the labor market or should they be more worried about inflation? I'm way, way, way on the side of the labor market, way on the side of the labor market. And just looking at these data points we got today, my argument would be, okay, sure, you had PCE go up 0.2 instead of 0.1 month over month, but you got personal income at a negative 0.4. You got a personal spending at a negative 0.1. And I think this personal spending is not adjusted for inflation. So this is not good stuff right here. But let me add more to the argument, or let me give you more evidence for why I would lean more on the side of the risk being in the labor market, not so much a reacceleration of consumer prices. Go over here to the Fed, New York Fed, and this is a report. I think their blog, this is what their blog is called, Liberty Street Economics. And this came out March 26th. Now, we've heard kind of rumblings of this. I've heard some podcasters talk about this, but it's a big deal when you actually think it through. And we know the student loans are having to be repaid now, and we're seeing the delinquency rates for student loans skyrocket. Now, I know this is going to take purchasing power away from things they otherwise would have bought, and that's going to likely lead to a decrease in economic activity, all else being equal. But what's, I can't get over this picture they used. What are they doing here? Look at this person's fingernails. What is going on here, man? I don't know. Like, why would you use this person's finger? Like, this is disgusting. Like this, why would you use a stock photo of a hand of someone that has no personal hygiene at all? I mean, whenever I see fingernail, this is obviously a guy. Whenever I see fingernails like that on a guy, it's just like, I don't know anything a guy could do to be more repulsive. That's just like weird. Like, dude, why would you like get some fingernail clippers, man? Anyway. I mean, am I wrong? Let me know. Ladies in the chat, if you're going out on a blind date and some dude shows up and his fingernails look like that, what are you doing? I would hope the answer would be, I'm out of there. I'm not just walking to the door, I'm running to the door. Wow. Anyway, okay. All right, what was I even saying? Yes, that's right. So looking at this blog post from the Fed, they talk about not only the fact that these student loan borrowers are going to have to start paying this back, but how the delinquency is going to impact their credit scores, and then how that pertains to the housing market, and how does the housing market pertain to aggregate demand, and how does that pertain to GDP, right? All these things are connected. And then GDP, how does that connect to interest rates, and whether or not the Fed should be more worried about the labor market or a reacceleration of inflation? You see how we're kind of connecting the dots here? So let's see if we can. I was listening to Stephanie Pomboy today, and she was doing a podcast with my good buddy Adam Taggart, and she had some data points suggesting that 1 out of 3 student loan borrowers are in jeopardy. They haven't defaulted yet, they're not delinquent yet, but they're in jeopardy of being delinquent, which would impact their credit score. Okay, well, let's think about what has happened since the Cerveza sickness. Well, people didn't have to pay their rent. Okay, that's going to be good for their credit score. People didn't have to, they got stimmy checks. I understand all that stuff is done. But one thing that was still lingering here were the student loans. So obviously, you're going to have artificially high credit scores. Well, a credit score helps you get a loan. It helps you qualify for a loan and helps you get a better interest rate. So assuming that we go back to the credit scores that we had for these individuals prior to 2020, and now likely getting worse because they're going to have these delinquencies that now will impact the non-payment that will impact their credit score negatively. What they're doing here is they're showing you kind of how things played out, what the current delinquent in 2019 and default in 2019. Okay, so they're showing us what it was defaulted in 2019, delinquent into the. Oh no, I see what it's doing. It's looking at more recent and saying, it's kind of putting people in buckets based on their actions prior to the Cerveza sickness. That's what they're doing. I'm not as much interested in that as I am the potential impact on the individual scores. So here's where we get into the stuff that I want to really look at. A larger share of student loan balances was past due after the on-ramp than before the Cerveza sickness forbearance. Okay, well, obviously that makes sense. Here's what I want to look at right here. A new student loan delinquency can reduce credit scores by more than 150 points. So let's just assume Stephanie's correct. And I don't know why she wouldn't be. It's not like she's making up data. That 1 in 3 student loan borrowers are in jeopardy of basically having their credit score just get annihilated. And so I guess the higher your credit score, the bigger point drop. I didn't even know that. But if you're someone that's like a prime borrower at 720, 760, you drop straight down to basically 600. So I don't even know if you qualify for a loan. So think about that. Right now, you would have people probably, and I'm not really in the market for mortgages, so I wouldn't know. You guys know about this more than I do. But I would assume that 660 and up, these people are easily qualifying for a mortgage, just depending on what the interest rate is here. But if you're a student loan borrower and you're in this category, 1 in 3 of them are gone. Like you're done. Like you're not even going down here unless you're 800 or something. You're going all the way down to 600, and I highly doubt 600 would be good enough to even qualify for a loan unless it's some sort of weird, subsidy type of loan from the government. So you think about the first-time home buyer, and it's quite often going to be someone who graduated, they get a job, they start a family, and they most likely have student loan debt, and they're the ones that are going to go out there and be highly motivated to buy a home. And I mean, it's not like there's 300 million of these people that are potentially going to see their credit score drop by 150 points, but there's millions. I mean, let's just say there's right here, given the estimates, we expect to see more than 9 million student loan borrowers face substantial declines in their credit score. And I guarantee you they're understating it. So let's just say 15 million people that just are out of the market for housing. Like they're done. And not just housing, I mean, credit. Think about what this is going to do for an auto loan. Like, and then think about what that's going to do to aggregate demand. I mean, everyone in the United States is all about the payments, right? Very few people are going out there and paying cash for a car. Obviously, even fewer are paying cash for a house. So their credit score dramatically impacts not only their ability to qualify for the loan, but the amount of interest they have to pay, therefore, their actual monthly payment. So, I mean, this is like a feedback loop here where you've got your credit score decreasing because you can't afford to make payments. And then all your other payments that you would have made are going up, which makes your personal financial situation even worse, lowering overall aggregate demand even further. And then when you combine that with the potential decline in home prices as a result, and of course, there's many other contributing factors, but I don't. So, bottom line here, I know this isn't going to play out over the next couple of weeks, and this isn't going to play out between now and when the Fed's rate decision is in July. But this is more kind of zooming out and looking at, okay, what happens over the next year? And is this going to lead to growth and inflation expectations increasing or decreasing? Is this going to lead to a weaker labor market? Or is this going to lead to likely an acceleration of inflation? I think you know my answer. I don't know. Obviously, if we get a big supply shock, then that changes the game. That changes the equation. But based on the totality of information that I have, I would say my base case is that you should be far more worried about the labor market and an economic contraction. Now, whether the NBER calls it a recession or not, who knows? But if I'm the Fed, I'd be far more worried about the labor market than I would about revisiting 2021 and 2022. Now I want to go over to GDP now. I accidentally pulled this up earlier because if you guys watched my video yesterday, I was talking about how the four components that go into GDP, and the negative drag on GDP is usually the deficit, always the deficit, because that's going to, if you, let's just say, have $10 in GDP and your deficit, your trade deficit is whatever, $2, then that's going to bring real GDP down to $8. Okay. So that's out of the four quadrants, out of the four contributors, the one is a negative, the other three are a positive. The other three would be personal spending, government spending, and business investment and inventories. So what the market was expecting was inventories to, stay kind of elevated, which is definitely a positive for the next GDP print, let's say Q2 GDP. But they're expecting the deficit to not just come down and normalize, but go way down to be like an outlier, like the opposite outlier, because we had the trade deficit go up so much, which is what the bulls were saying. Oh, well, that's, the negative 0.5 we had. It was just because of the trade deficit. And that's just because people front running the tariffs. And therefore, let's just say our normal trade deficit is 100 billion. It goes up to 160. So they weren't expecting it to go back down to 100. They were expecting it to go back down to like 30 or 40, something like that. And which would be a huge positive for GDP. But what we actually saw, at least in the more recent data, is inventories were actually declining. They were not staying the same. So that, all is being equal, negative drag on GDP, right? And then you had the trade deficit that did go down, but it didn't go down to 60. It's still right around 100. So how does that factor into the expectations for the next print of GDP? I said, you got to take it, you got to ratchet it down. especially since the last revision to Q1 GDP went from negative 0.2 to negative 0.5, when the expectation, by the way, was a positive 0.2. So then I went over to GDP Now, and if you guys were watching that video, you saw that I was a little frustrated because yesterday they hadn't updated their chart. The last time they updated it was the 18th. And I was like, okay, can one of the 900 PhDs that work at the Fed maybe update the Atlanta Fed GDP? But anyway, okay, that was me venting. But what I said is that when they do update it, this is going to have to come down. And we can see that's exactly what happened. Now, I thought it would probably be closer to 2, I think is what I said on the video. But we see that it's gone from 3.8 or 3.9 yesterday. Or no, that couldn't have been 3.8. Maybe it was 3.4 yesterday. I'm just trying to eyeball it here. But it's gone down to 2.9. So it didn't go down as far as I would, but it definitely went down. So let's see the reasons they gave for the decrease to see if my analysis is way off base or if my analysis is spot on. So GDP Now model, okay, got that. Seasonally just got it. Second quarter is now 2.9 from 3.4. Okay, I guess I could have just read it instead of eyeballing it here. After recent release from the Census Bureau and Bureau of Economic Analysis, or that's the BEA was what I was citing for those components that we were talking about within GDP. An increase in the nowcast of the contribution of net exports, they're talking about trade deficit, growth from 2.07 percentage points to 3.49 points was more than offset by a decrease in the growth contribution of inventory investments from negative 0.42 to negative 0.222. All right, so the bottom line here is I nailed it. I get some things right, some things wrong, but this is something that I just was spot on. This is exactly why they dropped it, exactly what I was saying yesterday, and why in that video yesterday I was saying, we got to look at this because maybe, just maybe, this leads to 2 consecutive quarters of negative real GDP, which would be a technical recession. Now, whether they call it a recession, I mean, Trump will probably do the exact same Biden did. And like, oh, well, that's not the definition. Oh, the NBER hasn't come out and announced blah, 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 blah. And, that's fair. Whatever. They're going to do what they're going to do. But the reality of the situation, and again, there is no certainties. And I'm not saying we're definitely going to have a technical recession, but the odds are way, way better for 2 negative quarters of GDP today than they were just a few days ago. But honestly, I don't think that would really impact the Fed's decision because you had at least Jerome Powell. Now, maybe, I don't know how much pull the other Fed governors have, but I don't really think that would impact Jerome Powell's decision or his view because of this core PCE number. And at the end of the day, he's going to really be motivated and incentivized to err on the side of inflation because he doesn't want to be remembered as the next Arthur Burns. I mean, I think there's a human component of it here for sure. Okay, guys, enjoy the rest of your afternoon. As always, make sure you are standing up for freedom, liberty, free market capitalism. We'll see you in the next video.